John's question is, do you have a strategy for a bad debit call spread option that has gone against me? Okay, well, similar to what we just discussed with the bear call repair for Eileen. Those are the same type of approaches I might consider with the bull call debit spread. And in this case, sorry. Okay, so May, 63.88, it came back. But we're going to do this. Let's say the stock did peak up above 65.10 with earnings earlier this week, dropped down to 63, came up to about 64.80 yesterday, then dropped back down to 63.88 today. It was as low as 63.20, I think. But let's say I did a bull call debit spread. And let's say we sold the 65 call at one point, and we got $1.20. And we bought the 60 call. Let's say, I'm just going to say 580. Okay, this is pretty high return, but let's just do it in that case. So we've got now it would have been lower than that. I'm sorry. I'm going to put 560 in there. My apologies. There you go. That's a little better. About in that 12, 13, 14% rate I'd look for an in-the-money debit spread or out-of-the-money bull put. And I trade an out-of-the-money debit spread, John, slightly differently. Oh, sorry, folks. That should have been closed. I apologize. Let's just do that so it's gone. Give me 1 second here. Fantastic. Sorry about the email. Great. Okay. So here's a similar position, John. It's a bull call debit spread, but now we're not losing too much money, but we are in the negative. The stock has dropped below our short call strike price. Now, in this case, might have used a bad example with MAS. It only offers standard expirations, John, and it only offers 5-point strike differences. So in this case, I can't use that one option where I would buy to close the short and roll it down in price, but that might be an option in this case if it's between the strike prices. The pendulum adjustment might work very well in this situation. I might sell to close the 60 and buy to open the 70, keeping the 5-point difference, but that's all I have advantage of. Now, it's going to be a lower return, but if that's still a 4 or 5 or 6% return, as long as the stock now stays below 65, that would be a good bet, wouldn't it? Let's take a look at a pendulum adjustment real quick on this position and see what options we might be able to do. Okay, so what am I going to do with one move? We're going to create a losing bull call debit spread into hopefully a winning bear call credit. We're going to sell to close our bought 60 call. We're going to buy to open a 70, which is very inexpensive in this case. So we take that value that we have, even though it's declining, we take that value we have back of it, and then we buy the 70 call for a cheap price of 10 cents, 5 cents, midpoint. Oh, so close. So this one didn't give me the profit that I wanted, John. But even if this was only a gain of $25 to the downside or 2.4%, even if it was 15 cents or $15 and only a 1% return, that's better than taking the small loss on the position right now. That is a potential to consider. And you said it had gone bad, so I don't know if, John, you're below both strike prices as well, or if it's between the strike prices as we were looking at here in this case. Okay, but that is one adjustment that could be considered. One thing I forgot to mention to Eileen, it was one of the ones that's in there, 1, 2, or 3. In the case of a bear call spread that we were in, and we just created a bear call spread, if the stock is going against you in this case, and you think it's going to continue to run, we do have an option in the bear call or the bull put credit spread to buy to close the short and let the long run. The risk with that, in Eileen's case, where she's in a bear call, if she buys to close this call that's deep in the money now and expensive without getting the premium back from the long, and now the stock reverses and pulls back, she could lose much more than that initial $1,000 max risk she had on the 10-point spread. Okay, but that's an option that we have in the credit spreads that we don't have in the debit spreads. See, if a bear call credit spread is going against me, okay, so let's, okay, let me just go, yeah, I just wanted to go back here. There we go. So here's what would be a bull put credit spread or a bull call. They're parity trades. I know this is a bull call, but let's say it's a bull put where I had sold the 65 put and bought the 60. Well, in this case now, I may be able to buy to close this put if my sentiment is this stock is going to continue down in price. Why? Because in the credit spread, the long option is going to keep increasing in value if it goes in your direction or opposite your original sentiment. So closing the short, paying all that money up front without getting a little hedge back from closing the long, if it continues to move in that direction against the initial trade, you may still be able to get a profit on this position. In a debit spread, that one is not available because as the stock starts to fall, this is a call now and it's losing money. So I can't buy to close the short in this case, leave the long open, because as it goes, I'm just losing further and further money on this one here, which is really my investment. That's what I'm losing money on. That debit, the success in the debit spread, of course, is the profit in the long call to counter that as well. So John, that's one thing that you should consider in that case is you don't have that management. But again, just like we talked about for Eileen, depending on where your bull call debit is, how far down it is, John, you can, one, do nothing in the hopes that the stock's going to recover and move back up. Two, close the position and take the loss. And again, we would normally look when we're in the 1% rule of the short call strike price for the bull call debit or the short put for the bull put credit and look to manage in that position. So close, take the loss, and look to make it back with other trades in your trading plan. Three, as you saw, you may be able to close the position and roll down to a lower debit spread if you think the stock is stabilized and is going to move back up in price. But depending on the loss you take, as we showed for Eileen, you may need to increase the strikes or increase the premium in that case. Four, if we're originally bullish on this position, it's been going down against us. So if I think it's going to continue, of course, close and do the opposite. I'm going to close my bull call debit spread, and then I might try to repair it by opening a bear call credit spread or a bear put debit spread as well. You could evaluate on your particular position that pendulum adjustment to see if it works. If it's below the single strike price again, or if it's below both strike prices as Eileen was, that condor idea, as we saw, is not going to work. Okay, we can't do the condor or add a bear put debit spread to create a debit condor to help with the repair because you're still getting hurt on this position. Okay, that's the case as well. Just closing one, we can't do that, remember, because this is going to continue. If I just buy to close the sell option now, that doesn't work the same way it does in a credit spread, so that's out. Okay, and then you could evaluate the pendulum adjustment in that situation as well to see if it works for you. I wouldn't suggest converting into any kind of elaborate type of position. Try to convert this to a butterfly. How would I convert a debit spread to a butterfly? Well, I'm already in a bull call debit spread. So if I'm going to try to repair it to a butterfly, we could add a bear call spread. Sell a 65, buy a 70. Now, in this case, it becomes tricky. Here we go. Because now you do have a potential to profit between the two. You get a better upper and lower break even, John. And the butterfly repair might be a good idea, but it's a small window of profit. And what did I do? Sort of increased the risk on the position. This is a 5 points margin requirement for the bear call side to create the butterfly, John, plus the 365 debit it costs to get into the position. You have 1 point where you've enhanced the return from about 13.6% in the example we're showing, which I know isn't your real trade, John, to 15.6%. But it's a small relative window of opportunity, and the stock is really close to that lower break even with this potential repair. And we've increased the potential risk on the position. We've doubled it, essentially, and that's in two directions. And so now we have two ways to lose with trying the butterfly repair on a spread position. I don't know. It does make sense. It can be done. And it might be a good idea. It might solve the problem. We couldn't do that on Eileen's because it was already beyond both strike prices. Trying to create a butterfly from that would have been very difficult. In this example, because the stock is just a little bit below the short call strike price in our initial bull call, we add a bear call. We complete the butterfly in this case. And get a little bit of edge to a break even, but now we have two ways to lose, and we've taken that original, what was it, 440 debit up to 865. So we essentially doubled the amount that we could lose there as well. Okay. All right. Okay, Don asked a question here. He says, how can we calculate the return on a debit spread? If the equity goes from a specific price, we have a 60 and 60 long, 65 short, and the stock is at 64 and it's 2 weeks until expiration. Okay, perfect scenario. Let's clear it out. Let's go back to our debit spread, Don. This is how I do it. I've got my debit spread here. And all I have to do is scroll down below my profit and loss chart, calculate expected profit and loss. What happens on Monday if my stock is at 64? Okay, so here in this case, if the stock's at 64 on May 3rd, based on the Black-Scholes pricing models, what you'd expect to see is a loss of $91. Theoretically, 65 call would go to about 77 from our original price. We got a 120, but our long would drop to 426. So this is our expectation of what we would see in that price. Okay. All right. So, and then once you do that, once you select that time, Don, it now shows you here on this side what your expected profit and loss would be at these prices that that the computer selected. There's your break even at 63.88. But this is what the gain or loss expected at the different strikes. And it redrew that red line for us, the curved red line, which was originally at the halfway point. Once you put the calculate field in there to see where your position would be, the stock fell to those prices. It redraws the curved red line for you on the graph, and you can hover over it specifically as well.